Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, October 3rd, 5:19 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market downgraded from mild correction to mild/moderate correction. I'll show our market expectations chart momentarily, and basically -8% off of a recent high is the dividing line between a mild correction and the beginning of a moderate correction, which goes down to 12%. Just the way that we classify market strength or weakness. Check the trend gauge over here. The near the end of week that closed on 9/22, we downgraded leaders to bearish. Yesterday, I put a yellow arrow on here as I saw some minor outperformance as well as outperformance by the Big-7, while the rest of the market pulled back. That was clearly a one-day wonder. As we gapped down this morning, ran up close to break even, but then 10 o'clock, JOLTS data came out, absolutely slammed stocks. We'll talk about that when we get to the tail of the tape. But leaders bearish. It's a look but don't touch situation with leaders. Then the five major indexes. We classify these their health across 3 time frames. Short term, all trending below the declining 21-day moving average. That's bearish. Also declining below the medium term 50-day moving average. That's bearish. Mixed bag on long term. NASDAQ 100 and S&P 500 holding on to the 200-day moving average. 200-day and the 40-week usually have a bit of a spread to them, and we undercut the 40-week and reclaimed it today. Didn't quite touch the 200-day on the S&P, but if you're looking for a needle in a haystack to find something positive in the market, an undercut and reclaim of the 40-week is about the best I can come up with. Long term, also terrible acting are small caps, mid caps, and the Dow. They're all below the 200-day moving average. So what happened today? As I mentioned, gap down. That was because yields higher overnight. We started ticking back higher as we came into 10 o'clock, and then every piece of economic data that comes out now is being poured over and causing a reaction to the markets. This morning was JOLTS data. This is job openings, and we had way more job openings than anticipated. Job openings implies a strong labor market. A strong labor market implies people are going to keep spending money. Keep spending money means is a tailwind for inflation, and that's not what we're looking for. People want the Fed to calm down on the lower end of rates. That's the Fed funds, and hope that that trickles through to the rest of the market, because uh, the 10-year and the 30-year, those are market priced yields. The Fed doesn't control those, and they just keep going higher, and that's a major headwind for stocks, that we've been saying for quite some time, and we're just getting more and more extended, defying statistical pullback uh, probabilities as it just keeps going higher. So that ramped yields, and that killed the market for the day, and also the S&P undercut day one of the rally attempt, so that kills the rally attempt. Technically still alive on the NASDAQ 100, as there is a tiny bit of relative strength there since the rally, but the relative strength that I highlighted yesterday was undone today on the Big-7 stocks. Bottom line, here are the numbers, and they're not pretty. RG8, our 8 growth ETF composite, down 1.8%. S&P 500 gap down 0.45%. As I said, near 10 o'clock was just barely down, but a big sell-off ensued after that. A couple of bounces intraday, those were promptly sold. Same thing with the NASDAQ 100, down 1.76%. Dow down 1.3, mid caps down 1.6, Russell 2000 small caps down 1.7. Global diversified 60/40 stock and bond down 1.01%. This is it was stocks, the 60% down 1.34, The 40% bond, global bonds down 0.52. Though actually the broad bond market domestically was down worse than that. So international bonds buoyed that number a little bit. In-house GROTECTION down 0.80%. We're not happy that we're losing money. We're happy to be losing less than the market, and we're getting closer to that line in the sand level. That's the 200-day moving average. I might as well bring that chart up now, because all bear markets, if this is going to turn into one, as I said, we're slightly more than 8% off of the recent highs, 4606 back in late July. If we're going to turn into a bear market, all of these occur with the break of the 200-day moving average and or the 40-week moving average. We're nowhere near that. We're only 8% off the highs, but we draw our line in the sand about that level, and we're aware that that's when the risk picks up. Markets are acting like some kind of credit event or something is coming. They're really making people pay up for these longer term yields. And if that's what happens, we'll be prepared for them. Uh, we dodged, since I've been on board with Revere, our rules have gotten us out of the December 2018, fourth quarter 2018, dodged COVID, dodged most of, not all of these, but we'll lose significantly less, and that's what part of the plan is. And I'll segue now into uh, our expectations chart, which is what we live by based on historical calculations of what happens in the market under different circumstances, how we position our portfolio during those times, and what the expectation should be. There's going to be times when we're going to underperform. That usually starts in um, when a new rally kicks off of the lows, because we're underinvested because we're coming off of a correction. When we start to pull back from a run, we're normally are overinvested, so we have minor underperformance there. Uh, we've really been in line. We're down about 8%, the same way the market's 8% off of the highs. As we go between, you see I have mild correction -4 to 8%, moderate correction -8 to 12%. At this point, if we get into a moderate correction, we will have broken the 200-day moving average and really not improved and gotten back above there. We should see minor outperformance during this period because we'll be underinvested. The correction gets worse, we'll see significant outperformance because we will be harvesting shorts at this point. As tactical moves to take advantage of the severe downtrend, we get into a big bear market where we're 20 or more percent, major outperformance. That's what we saw in 2022. At one point, we were only down 8% when the market was down 27%. Severe bear market will be dominant outperformance. This is where we really protect our client assets, is these harsh correction bear market, severe bear market. That's where we'll get outperformance. Coming off of the low, we'll underperform. This is what happened earlier this year when we bottomed, and late last year when we bottomed on a bear market rally. And there's times we're going to underperform. There's times we're going to really outperform. For example, bull type 3. Strong bull market. We were up 48% in 2020 after COVID, and that's while the S&P was only up 16%. So different market conditions. We've got a plan for all of them. Sometimes it's losing less. Sometimes it's staying in line. Sometimes it's losing a lot less and in fact making money if we can get on the right side of the downtrend. And then sometimes we can have major outperformance if we're on, or when we're on the right side of a strong uptrend. But these expectations, these last 13 bear markets, these fall into um, the harsh correction bear market and severe bear market. And then look at the numbers that it takes for them to get even. So uh, this is the approach that we take. Different market expectations. We talk about them every night here on video. We talk about the moves we're making to support that. Right now, we're very oversold, but we've been oversold for a while. The bounces have been not strong at all. Any little attempts that we made, there's really been 5 shots that we've taken over the last 3 weeks with small positions and growth leaders, and we got stopped out for less than 0.1% to a 20th of a percent impact to the overall portfolio, and that just tells us that the market's not ready. So we stick now with our index longs and or shorts. We closed our QQQ long today. As I described in the video last night, if we broke back below that ADMA, that was telling us that no, the Big-7 were in fact not going to outperform, and we got an ugly day today, and JOLTS was what kicked it off. So that's a little bit about our process. Let's get right into the S&P 500 and the index charts, our inter-asset correlation charts, and then some charts of individual names. And you can see here breaking below the low of day one of the rally. So this was the move down. Day one of the rally, very clearly breaking back below it. Never got above the ADMA in any substantial way for the S&P 500, and uh, oversold now for a week and a half. You can look back here and see how long we can stay oversold. This was almost 3 weeks. This was 3+ weeks with a fake out in the middle. This was over 3 weeks before that most recent rally off the bottom that failed. That included a follow-through day that also failed. And here we are sitting 0.7% above the 200-day moving average, which is down at 42.02. Let's go to the weekly chart here, and you can see the 40-week moving average is at 42.28. We undercut there and basically closed a point above that level today. And that's a key level too. I mean, it works in conjunction with the 200-day moving average. There's, in this case, a spread of about 0.75% between the two. So that's why we look at where are we on the weekly chart when we close to determine uh, is it a true failure of the 200-day moving average or versus the 40-week moving average. There's several rules that go into it. So that's your daily NASDAQ 100. That's the S&P. Here's daily, and you can see the close above and the relative strength line on the NASDAQ 100 yesterday with the close above the ADMA, 8EMA. A lot of people say I sound like ADMA, and they were thinking it was an acronym uh, of 4 letters, but it's not. It's 8EMA. And clear break back below the 8EMA, and it turned the slope of the line lower, down 1.75% on the NASDAQ 100. Still significant space between here and the 200-day moving average, 7.2%. We will be looking for relative strength in this. The way we talked about it last night, and it is doing it right now. Normally, in a correction, the Nasdaq 100 leads lower. It's not leading lower. It's keeping up with the S&P 500, and that's typically a good sign. But it doesn't mean we're blindly going to stay in those stocks and just watch our money disappear. Onto the Dow Jones Industrial Average, making a lower low since breaking below the 200-day moving average. Very much in correction now, as are the mid and small cap indexes. New lower low for mid caps, still above this 437, 438-ish support area, which was back in the May-June timeframe. But and again, very extended to the downside. You can see the multiple weeks where we can stay below. Here. Right now it was a fake turn up. We never got off of oversold before hooking back down. That's mid caps, same situation for small caps, just a little bit weaker even, making a lower low, still holding this shakeout low from early May and this late March shakeout low also before we tried to rally, didn't. You can see the relative strength line was lagging at that point too. In fact, it's very rarely been outperforming, except for this period here after that June rally off of the lows where we broke out of the cup and handle, but then failed badly within 3 weeks. Let's go to the VIX. VIX had a big up day today. That's not something stocks want to see. Briefly piercing above the 20 level. Above the 20 level were spike highs in early May and late May. And that's where we are too. Nowhere near the spike up to the 30 level that we got with the banking fears. But if these rates keep getting higher, Remember, part of the banking issue was that they had these 30-year treasuries on their books that whose value was declining lower because of long-term rates going higher, and long-term rates continue to make higher highs, and that's obviously not helping the value of these bonds for anybody that holds them, not just banks. So there's the VIX, not uh, volatility very clearly increasing. We're back above 1.05%. There's the VIX. Let's go to the dollar. Dollar, after the JOLTS data, it popped, but then sold off and just basically flagged sideways, very extended already. Maybe we'll get a break from the dollar and it'll trickle over to rates. But I say maybe because we never take anything off the table here. We've seen just about everything happen. So we're prepared for anything that could happen in either direction. Sometimes it's eyebrow raising that it actually did happen. But anybody that says that never happened before, so why worry about it, is uh, just not a understanding how markets work. GLD, lower low today with the dollar being slightly stronger. GDX gold stocks bucked that trend a little bit up slightly, and SLV silver barely higher. Terrible charts here. Bitcoin had a strong day yesterday. Pulled back 2.7% today, giving back most of yesterday's gains. Let's flip over to bonds. First, the broad bond market, lower low, as I said, um, down 0.8%. TLT, the long bond, down 2.15%. TYX, the 30-year yield. Look at how this just is. You think it's extended, and this is looking a bit blow offish, but I'm not going to predict that. Last time I did, I was 4 days ago, and I thought we put in a top with this attempted evening star, and we've made two higher highs since then. So something's going on in the in the bond market, and it doesn't look good. TNX, the 10-year, also higher high, but just bouncing off the 8 from 3 days ago and continuing to trend higher. So that's bonds, that's precious metals, that is rates, and that is the indexes. Let's go. I got a little list that I look at, make sure I didn't miss anything. So here's the tail of the tape. The fear and greed index dropped down to 17. This is extreme fear. I've seen it be single digits, but it's getting to the point where it's a contrarian indicator, and you can look for the bounce. We thought we were getting the bounce when it got back above 30 a couple of days ago, but no such luck. Later this week, the new readings from AAII will come out. The weak action, as they say, there's nothing like price to impact sentiment. I'm expecting a pretty big drop in bulls and a tick up in bears. I don't know if they'll approach the levels where we put in lows last time, but we will see. We're on the bear case with the sustained break below the 21 EMA. Day count down to 1, 13 days below the 8 EMA and the 21 EMA. On the S&P 500, we had a one-day reprieve on the NASDAQ 100 yesterday, but we need 2 days to make a trend, and we didn't get it. Expectations remaining negative with us being below the 21. Here are the sectors: just utilities and oil services outperforming along with the dollar, and bond yields. 10 out of 11 sectors of the spider sectors down. Semiconductors, software, uranium, and solars have just completely come apart even more. Look at this chart on TAN, TAN. I mean, this is, Green Energy Administration in the White House should be great. Really? From 84 to 47 on, and that's not in individual names. They're worse. This is the sector ETF, but whatever. In-house, SPXS, we trimmed some at one point today because we got oversold and bounced at the 40-week moving average. That was as oversold as we were. That was a normal spot to bounce. It was back in here, and we took off some of the short, and then we got up to 42.40 and rolled over again. And when we started to roll over again, that's when we ditched the QQQ. Well, first, earlier, some of it was sold as we broke the 8 EMA, And then after this rally failed, we sold the rest of it. So out of QLD, trimmed some SPXS, net, uh, dropped our adjusted beta to below a half, which is what our target is if we're under the 150-day moving average, which is very clearly where we are now on the S&P 500. So bottom line on the day, JOLTS data ramps yields, which slams stocks and kills the rally attempt. Tomorrow's another day. Uh, we've cut our exposure by 2/3 going back over the past 3 weeks to when we had a follow-through day and some stocks were set up very well, but the market gave us different signals. It's okay to be wrong. It's not okay to stay wrong, and we've been cutting exposure ever since then with the line in the sand just below where we are now, with the S&P 500 approaching the 200-day moving average. Let's look at a couple of charts here. Uh, some leaders that we missed the run on have completely broken down now. Let's look at two of them. ELF uh, coming into the 200-day moving average, so about a 35% move off of its high. Nice, 196% off the pivot in 303 trading days is a beautiful. But if you don't take the money off of the table when you need to, the market will just steal it from you. And right now we're coming into the 200-day moving average here. Let's look at another leader that has broken down. And this is as nice a failed bear flag as you will ever see. If you flip this upside down, it is a beautiful cup and handle breakout. In this case, it is a inverse cup with handle breakdown. Celsius down 7.4% on the day. From its pivot 101 days ago, still up 32%. That's the breakout from this base right here, but dropping from 207 down to 161.47 off of 207, 46 off 207. That's a lot. That's a pretty big pullback. And again, it's just we're not the shop that is going to stick with these leaders when they break the 21 EMA. We're going to take most of it off and we'll leave a runner. If it breaks clearly the 50-day moving average, we're out. Um, that's our process. Now, NVIDIA, we talked last week about how we sold the rest of it for non-taxable accounts. For taxable accounts that had significant gains, we were looking at a break of 400. We didn't get the break of 400, but we got what's actually better, which is a rally up and a fail into a key level, in this case, the 50-day moving average. So we hedged the NVDA, 60% taxable gains for the taxable accounts that still have the big gains. And we did it with NVDS, which is a 1.25% inverse ETF versus NVIDIA when it goes down. Same thing for Apple. Apple actually had the best day of the Big-7 today, but we took our Apple hedge off. We got a couple of clients with big legacy taxable positions. We took the hedge off when we bounced here near the 40-week. When we failed above the 80 MA, we put the hedge back on today. For Apple, Apple is showing a bit of relative strength, but below the declining 21-day moving average, we want to be hedged, especially when we're below the 21. Then it's also below the 50-day moving average. So those are some of the moves we made in-house. What other charts do we want to look at? DraftKings was another leader that had a decent run. This was, in fact, one of the last positions that we held before it broke the 21-day moving average, down 4% today. If you take a step back, it's just forming a base after a nice run up, after a breakout off of out of this this cup base back in March. A couple of others were down pretty big. VRT was one of the leaders that was holding up very well, still kind of right on the 21, but after 4 days up, 5 days up, it gave up most of it, down 4.1% today. Again, leaders, I should probably have this be the title of a video. You can look, but you can't touch. That's why we maintain our leaders list, but when the market winds are in our face and we're below key moving averages, that's all it is a watch list. Here's Zscaler. 2 nice days up, with a big upgrade, gave it all back in one day, down 5.9%. CrowdStrike was another uh, cybersecurity stock holding up pretty well, 5 days up. Took back 4 days of those gains in one day, down 4.4%. This is just how leading stocks act when it's not the right market for them. And with that, we're going to wrap up. As always, like to hear from you. The email's don@revereasset.com, or my partner Dan Stewart if you're interested in becoming a client. Dan@revereasset.com. You've been keeping them busy lately. We certainly appreciate that with new clients coming on board. The phone is 855 Real Wealth. That's 855-732-5932. So remember, it's not how much you make in the market, it's how much of that you can keep. Yesterday's green shoots, and we had some last week. Yesterday was the Big-7. The question was, were portfolio managers going to shove money into there? And they still might, but they sure as heck didn't today. And we sold our position when it broke the ADMA using the ultra short-term moving average in a market like this. And that's it. With that, I'll wrap up the video for Tuesday, October 3rd. This is Don Vandenbord with Revere Asset with the news that you need to know, not necessarily what you want to hear, but what you need to know. Thanks for listening and have a great day.